I'm 680 News senior business editor Mike Eppel. Less than 2 months after it raised interest rates and sounded all sorts of optimistic about the state of affairs for the Canadian economy, the Bank of Canada today was sounding a much different tune as it held the line on interest rates, the benchmark at 1.75%, and signaled to the market that it is dampening down expectations on economic growth going into the new year. The central bank talking about the recent plunge in oil prices and the negative impact that's having on Western Canada. As well, the weak business investment didn't cite specifically the announcement regarding General Motors, but it was sort of in the phraseology of the central bank that it's worried about the manufacturing sector and the fact that inflation may have reached a peak and there's more room to grow for the economy without spurring on price pressures. Now, this is important if you've got a variable rate mortgage, or, for example, and heavily indebted Canadians. The CIBC chief economist Avery Schenfeld says this gives Canadian borrowers a chance for a reset.
So this is a bit of a reprieve for those Canadians who are up to their eyeballs in debt. It gives them a little bit of relief in terms of the pace of interest rate hikes. That said, they still warn that rates would at some point have to rise. They haven't completely taken that warning away. But I think they just have to see more growth in things like exports before they can do too much damage to what the household sector can contribute by consumer spending and housing.
Now, in response to the Bank of Canada's new signals on the economy, the Canadian dollar cratered today. It was down more than a half a cent, bottoming out at a more than 5-month low, below 75 cents U.S. Toronto's real estate market has certainly been adjusting to higher mortgage rates this year. And November saw another cool down for sales. Sales down 14.5% year over year, according to the Toronto Real Estate Board data in for the month. But that may have had more to do with the fact there aren't many new listings on the market. New listings down 26% year over year in November. So there's lots of buyers out there, not many new listings and properties for sale. And prices continue to climb. The average price north of $788,000 across the GTA, up 3.5% on a year-over-year comparable. Canada's one-time hottest housing market is in a slump. Vancouver saw sales drop 42% last month from a year ago. The average selling price there still above the $1 million threshold, but the Vancouver market, which was red hot not that long ago, continues to adjust to rising interest rates and new rules put in place by the BC government. Well, warm fall temperatures have certainly cooled things off for Roots. The retailer today issued its sales forecast along with third quarter earnings and dropped the overall sales growth forecast for the year, sending the stock price tumbling by as much as 20%. Roots says the unseasonably warm fall temperatures led to a dampening off of overall sales. And the energy market's gearing up for a big announcement Thursday coming from OPEC. The cartel expected to announce a production cut. How much? That remains to be seen. But today we did see the price for oil rise north of $54 per barrel on the U.S. trade. From the 680 newsroom, I'm Mike Eppel for City News.